Okay, but the weave is no guarantee. Okay, you're not going to have, well, you understand what I mean. You're not going to have some kind of guaranteed trade with this. You still need to use smart money management. You still need to be aware of what happens if you get stopped out multiple times. The ideal is when the market breaks out and continues to move in our favor. More than likely, the market will do something else the majority of the time. So let's go ahead and continue. You can see the weave now is deep. Okay, the moving averages have joined. They're moving together. The red line is crossing over and under the blue. Whoops. In a very short period of time. Over and under. Let me try and zoom in a little bit more. So over starts weaving together. Okay? And actually, as I look at that, it barely missed each other on the cross. Okay? So it hasn't quite crossed again, but you can see that the moving averages are laying down, one on top of the other. Nearly identical prices. Now you can see they cross again. So we have them crossing, laying down, recrossing. All this happening in a very short period of time. 5, 10, 15, 20, 25 minutes. Okay, that's the difference between this and this. Okay, over here, remember, they separate very quickly. Over here, they separate and then come back together. There's the weave. Now, this is a perfect example coming up of a whipsaw. Okay, so the market moves up, triggers a long trade. Then the market immediately stalls out. Now, if you're in front of the screen, you can use this as an opportunity to get out, or you can just hold firm and stop out if the market goes underneath this low. Now, let's make sure that we understand what kind of risk we're talking about here. We're only looking at 24 pips. Okay, so you don't, and remember, okay, let me emphasize this again, even though I know, again, so if you're going to pay attention, now's the time. I'm not suggesting that you trade on a 5-minute bar. I want to use this as an illustration. Like I said, most of you are going to find a 5-minute bar overwhelming and very difficult to trade because you have to make decisions, boom, 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 very quickly. Now, on a 5-minute bar, if you have a 24 pip risk, you have to understand that if you go up to a 15-minute or an hour, this 24 pips could very easily go up to 30 or more. It could be, in fact, 50 or more. Okay, so you just have to realize that. So here you go. The market trips into a long trade, stalls out. Now we have the market, boom, falls down, almost triggering. Here we have a hand. Here we also have a hand. Again, because these are so close, I wouldn't use them both. I would, however, use this one. Actually, let me check. Yeah, we have less than the spread worth of difference there between the two. So the trigger point is right here, very, very close. So if I were long here with a stop and reverse down here, as soon as this level gets hit, if I bought 2, then I'm going to sell 4. That way the 2 cancels out, and then the 2 cancels out, leaving me with 2 to continue moving down. And then you can see the momentum kicks in, the market breaks below this hand, momentum is starting to gather. You can see, look at the difference in the bars, much wider bars than over here. The market slowed down very rapidly right there. So the market, boom, pushes through, hesitates for just a little while, right down here at support. In this support zone here, it hesitates, and then it's underway. So very quickly, you're out 24 pips, true enough.